Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit. My name is Mathew. Like the name suggests, this show gets you actionable insight on everything related to mutual funds, whether it is a query that you've sent in, and hopefully we can play that number on your screen so that you can see where to send it to us, or in fact on investment advice that you should get. And often on the show, we also speak to the people that manage your money so that you understand what their thought process is, how they go about the managing of your money, and what they're reading in the trends that are currently visible in the markets. Today, my first guest is Mahesh Patil, Chief Investment Officer at Aditya Birla Sun Life AMC. Mahesh, thank you so much for taking the time and for speaking to us on the Mutual Fund Show. It's an interesting setup that we have, but before we get into some of the nitty-gritties of the large cap fund that you are managing, I do want to ask about how you're seeing the current setup, not just here in India, but everything that is playing out globally. Where do we stand, and what are you most focused on?
Yeah, good afternoon. So if you look at things as they stand currently, I mean, this year has been a period where we have seen initially, the markets were a bit negative. There were concerns about growth slowing down, more so on the global side. We are looking at some rate cuts. But I think if you look at the overall on the global side, it has surprised. The growth has actually surprised on the positive side. We have seen actually updates to on global GDP growth, and more so in the US. And also the rate cuts, which one were expecting, I think they are now getting pushed out. And we're not likely to see, say, at max probably one or two rate cuts in this calendar year. and and since the earnings growth outlook has been fairly decent, and growth numbers have grown, the markets have also actually done much better than what one would have expected over there. And India also, I think, after the initial kind of correction, what we saw in the month of February, March, and also at that point in time, there was concern about the mid and small cap space because of the large outperformance it did in the last calendar year. And valuations had gone slightly ahead of the fundamentals. So there was a reason to believe that you could see some kind of a moderation over there. And to some extent, we saw that. But I think post that, we have seen, again, some kind of a risk-on rally globally. And in India also, we have seen things again climbing back to the earlier highs. Overall, I would say that the market outlook, if you look at it, it looks fairly stable at this point in time. Even in terms of the earnings growth for this quarter, if you look at it, there have been some disappointments, but by and large, we have not seen any major downgrades to earnings for the current FY25 fiscal year. However, clearly, I think this year we'll see a moderation in terms of the earnings growth. I mean, last 3 years, we have seen Nifty, for example, the earnings CAGR has been in the excess of around 20%. I think that will come down to around, say, 13, 14% is what we're looking at. And the broader market, while there are pockets of overvaluation in the market as we see, but if you look at the Nifty and the large cap names, they are somewhere near the long-term average, right? Because if you look at in the large cap, the Nifty, for example, the Nifty returns in the last 2 years is more or less in line with the earnings growth. So we think that the market is fairly priced, probably slightly above the long-term average, but not too much. The sentiments getting into elections, we've seen that the markets have rallied because expectation as you will have continuity in the current regime, but could see some volatility around that period. But by and large, I think markets look fairly stable. I think there is the growth also, especially the domestic sector, and domestic growth outlook to be fairly strong.
Okay, we're speaking a week or just ahead of the outcome of the FOMC meeting, and I think by and large globally we're expecting there to be a pause. How much of an impact do you see for our markets, and not just about FOMC, but everything that is playing out globally? Both the geopolitical tensions, which don't seem to be going anywhere, the crude price, which is something of a joker in the pack for India, and also monetary policy. How much of a bearing is that going to have in the remainder of this financial year, according to you, Mahesh?
Yeah, so I think what all these factors, what you mentioned, are pretty pertinent factors, okay, which could impact the market either ways. So on the FOMC, I think on the policy made, I think while there is expectation of a pause, but I think the way the US growth is, and also to some extent, we have seen that while inflation trajectory has been coming down, but there has been some risk on the on the commodity side. We've seen commodity prices have gone up both on the metal side. Oil was trying to move up above 90, but it's still now under control. But you never know because of the geopolitical risk. So I think the expectation of rate cuts, what we are looking at in this calendar year in the US, I think that could be at risk if at all that doesn't come through. It remains higher for a longer period of time. Then okay, that could be negative in the second half because that could mean that the as a result of that the kind of a slowdown which you could see in the US economy could be much sharper. So clearly that's one risk, okay, which one should be aware of in the second half of this calendar year. Apart from that, I would say that the geopolitical risk remains. I mean, we have seen tensions across the world in various pockets, though they haven't escalated, I think. And the good thing is that we've seen signs of them trying to escalate, but they have not really gone beyond. So that's really kept on the supply side, okay, the disruptions which would have expected. We've seen some disruption, but not really too much. But clearly that again remains a risk because any supply side shock could mean that inflationary pressures, okay, would again start to move up, and that could further hurt the sentiments over there. So I think these are the kind of two risks, okay, which could lead to, I think, volatility over there. From an Indian context, I would say that we've seen the while the growth recovery has been very strong. I mean, seen a good on the investment side, on the consumption side, the recovery has been still pretty slow. If you look at the numbers in this quarter for the consumer names, right, rural consumption that has been weak, and if the monsoons are not that great, right, okay, that could put further pressure over there. So I think the broad-based recovery, what we were expecting, I think that could probably be in danger, and that could put some
So
risk to the
therefore, the
market.
question that I have is that if we were anticipating, Mahesh, for some time that there would be a bit of a rotation from the broader markets, from the mid cap and the small cap space into large caps. Have we started seeing that? And the reason and the context that I'm asking this in is that last month we saw a little bit of a moderation in the flows into these schemes. Is that now going to show up in the way that the markets perform as well?
Yeah, so I think you're right. I think the expectation was that you could see now this year the breadth of the market, okay, which was very broad-based last year, okay, that will start to narrow down. You were seeing some signs of that in the last couple of months, where if you look at the Nifty, for example, the equal weight Nifty index is, which was outperforming, the Nifty has started to slightly underperform, and I think also the fact that the noise, okay, which was made on the mid and small cap side, and the regulator also getting slightly concerned over there in terms of how that could impact because of the liquidity conditions. But I think to a large extent, I think those concerns, okay, which in terms of the how the mutual funds will be managed liquidity if large inflows come into the small and mid caps category, have been addressed in terms of better disclosures from the mutual fund side. We've seen as a result some moderation in inflows over there on the mid cap and small cap side, and some money of the money has moved into, say, large cap or into the hybrid funds, or even the arbitrage fund to some extent. I would guess that as we move forward, I think our view also is that the large cap, the risk reward is slightly better, and you should see we're also asking investors to kind of rebalance their asset allocation, okay, in equity specifically because of the outperformance and the large money which came in. The exposure to mid and small cap in the client's portfolio would have gone up to try to rebalance that. And I think that should see, I think, more flows coming into the large cap and the flexi cap category. But I think what is also driving the large caps or the mega caps is also the how the FI flows are behaving.
Yes.
Because we have seen some outflows from FIs even in this month, and that is because of some large names, okay, where we've seen FIs trying to reduce their positions, and that is still weighing down a bit on the large caps. So we've seen now in the recent past, actually, the mid and small caps, especially the mid caps, okay, which had a kind of corrected mid cap index, is now bounced back and are almost near to its earlier peaks.
So it's interesting because, and that's the perfect opportunity for me to ask you about the strategy that you employ, Mahesh, which is growth at a reasonable price. And I guess to a certain extent that reasonable price is, you have to adjust it over a period of time. So how are you looking at that reasonable price right now in the large cap space? Are you finding comfort in valuations at all? And are there specific names where you have a reasonably large holding where you're saying that these are good levels to accumulate at?
Yeah, so I mean, you're right. I mean, growth at a reasonable price is always a question. Okay, what's the reasonable price? Right? So again, so we also, when we talk about, we also take into consideration the future long-term growth potential of the company, and then try to look at it. Because if you look at a company from a next 2-3 year perspective, it always seems to be priced in, right? So you have to look slightly beyond that. But I think the good thing is that there has been some kind of a moderation in valuations, what we've seen. So especially for the growth stocks, right, which were gone to crazy multiples around a couple of years back. In the last 1 year, we've seen them moderating over there. So clearly, I mean, not exactly cheap, but I think relatively adjusted for growth. I think there are some of the stocks, especially in the growth-oriented sectors, we have seen that correcting, especially in the consumer discretionary side, consumer durables, the QSR space, where because of the slowdown, what we are witnessing at this point in time, we have seen a moderation over there. So, but I think by and large, if you look at in the large cap space, the large mega cap name, as I said, if you compare that, compares stock specific, there are quite a few stocks which are either near to their long-term average valuations. Okay, so they are reasonably priced. They are not cheap, but are in some cases even below that. So those are could be interesting stocks to look at over there. And if you look at from a sector perspective, if you look at the banking sector, for example, right, the banking and financial services sector, clearly that has seen us has underperformed a bit in the last 1 year, while the earnings growth over there has been fairly decent and strong. We saw last year was very good for the banking sector, where there was an expansion in the net interest margins. The credit costs were also at an all-time low. And within the Indian economy continue to do well, I think the overall credit growth also should be healthy. I think we should aid over there. So I think that is one sector, okay, where you could say that the valuations are reasonable, and the growth outlook is also fairly decent over there.
So from the benchmark
Yes.
perspective, Mahesh, traditionally, if you're talking about that range that the Nifty 50 has forward PE, it's currently at what 25 times or thereabouts, and it's in that range of 23 to 25. And you would say, if you look at it based on how it's been in the past, that perhaps it's at the upper end of the spectrum. But is there an argument to be made, according to you, to push that valuation multiple higher? Is that reasonable now?
No, so if you look at the Nifty 1 year forward P, we look at slightly 1 year forward. What you're talking about is the current P multiple.
Sorry, yeah.
On 1 year forward, the range would be somewhere closer to, now if you look at a 10-year average, it would be somewhere around 19.5 to 20 in that range. And we are somewhere near that range, only slightly above that, right? So it's slightly above the long-term average, which is fair, I would say. But I think the reasons for multiple to read it could be one or two reasons why, okay, the valuations could remain at a slightly higher premium. One is that from a macro construct, if you look at India, is at a much better shape than what it was, say, around pre-COVID, right? We've seen both on the current account deficit, we have fairly comfortable forex reserves at comfortable levels. We have seen that the rupee has been fairly stable. In fact, last year we looked at the rupee volatility was on the bottom decile if you compare it vis-a-vis all the other currencies, both developed as well as the emerging markets. So clearly, I think we are in an environment. We are also getting into a phase where we're seeing now the fiscal deficit in a fiscal consolidation mode. Fiscal deficit is now much under control, and also as a result of that, I think there is a possibility, and our growth also has been fairly stable, right? A combination of these factors, I think India stands out amongst all the other markets, not only in emerging market, but also compared to some of the developed economies. And there is a case probably for India's rating upgrade, okay, to increase down the line. So in that scenario, I think you would see that the risk premium, okay, for India is likely to come down. One can make a case for that because of greater macro stability, lower volatility in the indices,
Yeah,
and that. So if the risk premium goes down automatically, your valuations, right, premium
will go up.
can increase, and also relatively, if the growth is better than what the other opportunities are in the other economies or the markets, I think India clearly stands out over there, right, in terms of the overall growth of the economy, which is looking much better. So there's always a premium for growth, okay, which we pay, right? We see that good quality growth stocks which are there. I mean, market has been doing that, paying that premium. So I think given that, yeah, I think if it continues to deliver, I think the multiples can expand, but I think we're not basing the base case over here. Our assumption is that the market returns from here should be now in line with the earnings growth. We
Fair point.
don't expect, because there are some uncertainties, there are challenges, there are risks on the global side. So in that context, I think if you don't assume any rating, I think earnings growth is what I think we should expect for the markets to deliver.
I'm joined now by Rushabh Desai, who is the founder of Rupee with Rushabh Investment Services. Rushabh, thanks as always for taking the time. Would you say that it is in fact a time that you should look at rebalancing, and how would you go about it?
Hi, Alex. Thanks so much for having me on the show. Let's beat the fact that markets today are doing very well compared to other economies globally. So, in today's time, markets are definitely not cheap. But of course, there are certain pockets in the market which are reasonably priced, which is the large cap segment compared to the mid and small caps. Now, there are two parameters where profit booking and rebalancing can be done. One is that, say, like if your mid and small cap, as since we are talking particularly about mid and small cap, I'll be touching on that specifically. If your mid and small cap allocation has subsequently jumped over and above over your original allocation, then rebalancing can be done. And second is, if your goal is coming near in the next 6 months to a year, then rebalancing can be done as well. So these are the two parameters where I feel, one is that if the allocation has jumped quite a lot, and second is if your goal is coming near in 6 months to a year, then rebalancing can definitely be done.
Okay. When you actually take up this rebalancing, then what is the best approach to doing this? Because now for many years we've established that over the long term in the large cap space you're better off with a passive strategy, but over the last year and a half we've seen quite a few of the active strategies actually manage to beat the benchmark. So at this juncture, what according to you is the way in which to carry out this rebalancing?
See, Alex, rebalancing should not be done very frequently in the short term, because what happens is that if you keep on rebalancing, readjusting on a short term basis and on a frequent basis, it breaks your compounding process, number one. And once it breaks the compounding process, the returns are also automatically affected. Now, rebalancing is also subject to taxation as well. Okay. So I usually tell this to my clients. See, rebalancing should be done occasionally over a medium to longer term perspective. Just because, say if you have invested for 3 years, for example, and if your portfolio has completely the allocation has skewed maybe towards mid and small caps, and if you're not comfortable, I would not suggest, see, stick to your goal and your time horizon. If your time horizon say is of 10 years, then probably say like on the 5th year or on the 7th year, if the allocation in the mid and small cap has jumped substantially, say from your original allocation is 50%, then if it's jumped to around 60 or 70%, then little bit of rebalancing can be done. But definitely not too frequently, in my view. Maybe over a longer period of time, if you have a 10-year time horizon, maybe once or maximum twice I would rebalance. I wouldn't fidget too much, to break the whole compounding process, Alex.
All right. So we've got, as we normally do, queries from our viewers, and this next one, Rushabh, is from Sandhya Nagarajan, and she's 25 years old. She's got an initial target of accumulating 1 crore rupees, and she's wondering what SIP she should plan over the next 5 years in order to achieve that. So by the age of 30, she wants to have 1 crore corpus. What fund should she look at, and what kind of returns can she expect?
Alex, we usually tell this to our clients, 5 years is a very short time horizon, especially you're going into SIP methodology. What it does is that SIP, invests every month at all points in the market, whether it is a high point, medium point, and low point, and it averages out, right? So usually 7 years, 6 to 7 years is a minimum time horizon with a buffer period of 1-2 years, because we need to keep a buffer period as well if markets turn downside suddenly towards the end of the 5th, 6th, or 7th year, right? So have a minimum time horizon of 7 years, in my humble opinion, if you are venturing into the pure equity segment. If you have a 5-year time horizon, then venturing into something called as balance advantage funds is something what I would recommend. These are hybrid funds which are dynamically managed. As per the trends in the market, say like if the equity segment has jumped up quite a lot, then of course the fund manager will trim the equity allocation and go into debt, and vice versa. So balance advantage fund is something what I would recommend if the investor wants to stick to the 5-year time horizon. If the investor can broaden the time horizon to around at least 7 years and above, then of course pure equity is something what I would recommend. On the balance advantage side, don't expect a lot of high returns, anywhere between say 9% or 10% on a 5-year basis. Of course, see, we cannot predict returns. I really cannot predict returns. But historically, on an average, on a rolling return basis, what I pulled out some data is around 9-10% is something what one can expect from balance advantage funds. Of course, double-digit returns can be made for sure. There is no doubt in it, but only time will tell.
Okay, so assume that you're doing 7 years and not 5 years, and you want to do an equity portfolio. What is the amount that you would suggest having an SIP of?
I think if 7 years is the time horizon, then definitely around say like 25 to 30,000 rupees per month is something what I would recommend. But again, if the investor does not have that much of cash in hand to do an SIP, doing a top up of anywhere between say 10 to 20% also works best.
Okay, fair point. There's one more question that I'd like to take. Ritesh Nair is asking this. He's 50 years old, and he's saying that he's got a Parag Parikh Flexi Cap Fund SIP of 40,000 per month, Axis Small Cap Fund of 10,000 per month, and Kotak Debt Hybrid Fund of 30,000 per month. He's looking at generating a retirement corpus of 1.5 crore, and he wants to continue this for the next 5 years. He's wondering if he's doing the right thing.
First of all, the amount seems to be very good. He's definitely doing a good job.
Yeah.
He has 2 little funds in his portfolio. Around 40,000 is concentrated to just one fund, Parag Parikh Flexi Cap Fund. So I would recommend, to have a little bit of a diversification. Say like, have 60% into Flexi Cap funds, which consist of 2 or 3 funds, 1 mid cap fund and 1 small cap fund. So have around 5-6 funds of different styles, growth and value both over a longer period of time, and divide this money equally, on all these funds. I think he'll be very well sorted. I don't think he needs to, change his SIP amount, but definitely from a fund perspective, he needs little more diversification.
Okay, so then to that end, very quickly, from the Flexi Cap space, could you tell me funds that you like? And you mentioned a mid cap fund as well. Is that something that you would suggest, and which one would you say he should consider?
So there are 5 funds what I can suggest him. Parag Parikh Flexi Cap Fund, he can stick with it the way it is. HDFC Flexi Cap Fund is something, another fund what I really like. Kotak Flexi Cap Fund, he can look into it as well. On the mid cap side, he can look at Edelweiss Mid Cap Fund, and he can stick with the Axis Small Cap Fund the way it is. He can invest in all of these 5 funds in equal proportions. I think he'll be very well sorted.
Okay, fantastic. Thank you, Rushabh, as always, for taking the time, and hopefully our viewers have gotten advice that they can use and put into practice very quickly. That brings us to the end of this particular edition of the Mutual Fund Show. It's been a pleasure bringing it to you. Do stay tuned. Lots more coming up over the course of the day. And this is NDTV Profit.